Hey, folks, welcome to InTheMoneyStocks.com's weekend edition of the daily analysis video brought to you by the creators of proprietary price, pattern, and time methodology. Learn the PPT strategies and profit for life. My name is Gareth Soloway, Chief Market Strategist here at InTheMoneyStocks.com. All right, into the action we go today on this weekend video. Markets again on Friday closed right around the flat lines. S&P was down 60 cents, Nasdaq down 11. Dow bucked the trend up about 29 points on the day. So again, when you average it all out, it was really a flat day on Friday. The markets gyrated a little bit during the day. If you're looking at the chart that I have up right now, which is the SPY, remember the SPY is the tracking ETF for the S&P 500. So essentially, this is the S&P 500 we're looking at. We're looking at it on a 10-minute time frame, which means each of these candles before you, which are these bars up and down, those are each 10 minutes during the trading day. All right, and again, here's Monday, Tuesday. Remember, Wednesday was New Year's, so the market was closed. Thursday and Friday. So this is all the intraday action you're watching here. And it was very interesting last week, not a surprise, but interesting to see the markets rally up into the end of the year and then see some selling. So I think that's the first thing I want to discuss today. Why did we see price action trending higher into year end and then lower on the first couple days of the new year? All right, oftentimes people say, oh, first couple days of the new year, you'll get some, happy people, excited people, new year, putting more money into the market. But here we saw some selling. So why did that occur? I'm going to explain it simply right now. All right, first off, end of year is where you get window dressing. What is window dressing? Window dressing is where money managers, hedge fund managers, anyone who basically has investors giving them money to manage, they're going to make sure that when their end of year statements go out to those public investors, those statements look the best as possible. Thus, the term that Wall Street uses called window dressing. So they're going to make that window look as pretty as possible, which means they're not selling any of the winners. In fact, they're probably buying some that they didn't have on their books into year end to make those window dressing appearances of those statements appear even better. All right, that's the way Wall Street works, folks. Into the end of quarters, into the end of years, window dressing does occur. The winners get put in, the losers get dumped. Well, at the end of 2013, frankly, there were not a lot of losers out there. So the losers were obviously getting sold, but there were almost none of those. The winners, any ones that you did not own as a financial fund manager, you were buying, and you were definitely not selling any of your winners into the end of the year because you wanted them to show up on the statement. So into the end of the year, that's what we saw. And that's why the markets really couldn't go down into year end, because there was no selling. You're not selling your Boeings, your FedExes, your Twitters, your Facebooks. You're not selling if you're a fund manager. And if you didn't own them, you're buying them. So that's what we had going on there. And again, that explains why the market was able to float up early in the week. And then, come the new year, these fund managers aren't stupid. They know very well that you will see some selling as profits are now taken. All right, so new year, don't have to pay taxes on that money anymore. New year, you have a whole quarter to deal with it. You can always buy those stocks back at the end of that quarter, but as fund managers, they're not ignorant in terms of the valuations. Valuations on stocks are very rich. Just look at the daily on the SPY. All right, this is the S&P daily essentially. Zoom out just for 2013. Look at this move up. S&P up approximately 30% for the year. Now zoom out to the next year. Then the next year, back to 2011, 2010, 2009. Look at that, folks. That is an epic rise from approximately 67, 66 on these spiders in 2009 lows, all the way up to 184.69, which was the 52-week high we hit on the New Year's Eve session. All right, that is an unbelievable move. We're talking well over 100% here. We're talking close to 150%, give or take. Epic move there. All right, I think it's a little over 150 to be exact. But again, as a fund manager, if you're in a stock that just was up 50% in 2013 and probably 100+% since 2009, you have to be smart and say, all right, listen, my statement went out to my clients, and it's showing, beautiful things here that I owned all the great stocks. Even if I didn't own them at the beginning of the quarter, I bought it right at the end, so my clients think I owned it all quarter. And I mean, that's the shady part of the industry there, which we can talk about a little bit more later. But bottom line is, the end of the year comes, the beginning of the next year starts, they start selling and taking profits. Because again, they know that these stocks are going to come down. And folks, I'm telling you right now, 2014 is not going to be as happy a year. You're not going to see indices up another 30%. In fact, I'm looking at a negative year based on all calculations out here. Now you might say, well, how come? Well, putting it basic, simply as I can, you went into 2013 in somewhat of a fear panic mode. If we go back to 2012 right here, you can see early in December or early November, you had a big sell-off there. There was a lot of fear about Europe. There was a lot of fear about the U.S. And was there a recovery? And then you kind of popped up here, but you still had a lot of fear. Now you won't going into 2014 with a lot of bullishness. And that's a problem. Right? You might say, well, how come? Why is bullishness a problem in the market? Well, because you're factoring in only the positive. The market is saying, or the market pricing of the S&P and individual stocks are saying, we think it's clear sailing ahead. So you're pricing in best case scenario. Well, what happens when there is a little blip on the screen? What happens when there's something small that comes along? Well, guess what? The market hasn't priced that in, as opposed to where we were in late 2012, before 2013's mega rally. So this is one of the major issues with a market. Markets are emotionally based. People think they're trading individual companies when they're trading stocks or investing in stocks. You're not. Hate to break it to you, but you're not. You're trading emotion. All right? This is why I trade charts. All right? I look at a chart and I can tell with insane accuracy if it's going up or if it's going down. And the key is the chart will show you that irrational exuberance in the charts. All right? Like now. So very, very obviously, does it mean the market can't go up a little bit in 2013? No, sure. I mean, of course it can go up a little bit. But is there more risk to going long up here or going short? And very clearly, after such an epic run, I'd rather be short. There's no doubt about it. All right, and for those of you that don't know what short is, it's being on the side where you win money or you make money when the market goes down or a stock goes down. When you're investing, by the way, just to break it down simply for newbies out there, when you're investing, think of it like putting a bet on. All right, we've all done blackjack, we've all done roulette, right, or something like that. All right, you're betting. If you go long a stock or you buy a stock, you're betting it's going to go up. If you go short a stock, you're betting it's going to go down. You get paid out both ways. You know, if it goes up and you're long, you get paid out. If you short sell it and it goes down, you get paid out. All right, one or the other. Now, if you're wrong and it goes the opposite way, then you lose money. Very simply. All right, so in any case, bottom line is markets early in the year now, we're seeing a little profit taking from fund managers. I am watching a couple things in the coming days. Number one, here was Thursday's price action. Here was Friday's. Thursday's price action was a nice down day with a low right here. All right, we had a low around the 182.50 level. If on Friday we had closed below the 182.50 level, I would have been more bearish. Because we didn't close below that low, you're kind of more in a neutral setting. And you might say, well, how come? Well, anytime you have a new multiple year high, in this case it was an all-time high in the spiders, but it's a new 52-week high bottom line, and you have a big reversal off of that like what we had on Thursday after the new year began, you always look for confirmation, what I call confirmation, and that's a secondary down day where you close below the low. All right, and needless to say, on Friday, we didn't get that. Now, you still got a market that closed flat on the day. Spiders SPY down 3 cents. We talked about the S&P being down about 60 cents on the day. But that confirmation signal would have been powerful for a bearish sentiment to the market in the short term. All right, instead, what we're seeing here is more of a, it wasn't up a lot, it wasn't down a lot, it was a flat, so it kind of kicks the can down the road, and you stay in that more neutral setting. Now, in the coming days in this next week, a couple things we're going to be watching. Does the market come up here and take out those highs? If it does, then you stay in a neutral positive motion. I wouldn't be long, to be honest, because I think the market could crash at any moment. And again, when you're priced for perfection and you're up, 150% off 2009 lows and 30% in 2013 alone, you have to be aware that you could absolutely crash. I mean, a 10% decline in a few days or even one day is not out of the realm if the right news hits the market. And this is where you have to be defensive as an investor. And you can't be going long up here. And the sad thing is, most average investors are going long, and they've been going long over the past few months, past 6 months, and so forth. And I shake my head at that. And it's not to say that they haven't made a little bit of money on the way up over the last 6 months. They absolutely have. But the problem is they'll stay in the market as it's crashing, and they'll only get out at the lows. They're buying at the highs. If you look at 2009 to 2000 and end of 13, all right, let's zoom out again and show it. All right, institutions were buying all here, money managers and so forth all here, and then right here towards the end, this is where we've seen money flows go into mutual funds. And mutual funds, needless to say, are where the average investor invests. So that as mutual funds are buying in here, or their money flows are increasing, it's coming to the end of the run, because just from history, I mean, look at any boom and bust cycle. The little investor, the average investor, gets in towards the end, and the institutions are selling right into them, and that's called distribution. And again, when you get the high volume towards the end, or at least an increase in volume, and I think in this period the volume's been so light lately that it's probably small unloading periods with institutions, but they absolutely are looking to take profits and just dump into the average investor's hands. Okay, but in any case, the risk reward at these highs is not to put your money in the market. All right, and again, it's not to say that you can't go up another 10%. Sure, you can, but if someone came to me and said, "Listen, you could make 10% over the course of a few months in the market, or you could lose 20 or 30%," what am I going to do? Well, I'm definitely not going long. I'd rather be short. I'd rather risk 10% to make 30% instead of risk 30% to make 10%. So you just have to think like that. You have to look at a chart. I mean, just look at the S&P 500 from the lows and say to yourself, is it smart to be long here? For instance, let's take an average kind of scenario analogy. And if I came to you and I said, "Listen, I have some jeans for sale, and you know, they were on sale last month for $70, right down here at the lows on the S&P in 2009. All right, last year, so we'll say $70, and I've decided to jack those up from $70 to $185, which is what the spiders are. The S&P's, if tracking ETF is at. And I said, "Listen, all right, so I've just jacked the price up 150%. Now I want you to buy. Are you going to laugh in my face? Or are you going to buy?" Well, I mean, in that scenario, you'd laugh in my face most likely. So it's very interesting to see how the little investor gets sideswiped by the emotion, which is built up by the media and all these other factors, just over and over again, to get on the wrong side of the trade. All right, and again, guess what? When the market starts pulling back and we see the next crash, and we will see the next crash, there's no doubt about it. This boom bust cycle, which has been created by the Federal Reserve, is only getting amplified by what the Fed is doing, which is printing 85 billion, well now 75 billion, but they're still printing 75 billion every month. Their balance sheet's gone up to about $4 trillion now, from under a trillion before the crisis. And they're obviously pushing interest rates, or trying to keep them lower. As those interest rates rise, that's a negative for the market. We'll cover that a little bit later, but bottom line is, the market is setting up here for a much more volatile 2014, especially based on cycles. All right, for those of us that know cycles, that's a very important little factor too, which I'm not going to get into here, but it is worth noting for those of you that go back to the last beginning of the crisis and then map it out based on time counts and so forth. All right. Other than that, let's quickly go over a couple little other things. I know I got sidetracked here a little bit, but I think it was all valid stuff I need you guys to hear. But going into this next week, I'm going to be watching. I'm going to be in a neutralish mode right now. I did pick up a couple shorts on Friday, which I think are good, already in the money, over $1 on one of them. I'm not going to say the name because that's for members only. But if you want to join the research center, you're more than welcome to, and take the 7-day free trial with us at InTheMoneyStocks.com. But just quickly on gold. Gold had another nice update on Friday. Now, short term, it's too far up to play. All right, in my opinion, it's too far up to play, but it has confirmed above the 20. So this major upside move, it has to be respected now. Absolutely has to be respected. You would now be not a buyer at these high levels, but on a consolidation pullback, I actually think you can buy. Your stop would remain at the lows right here. Any close below or confirmation move below, that would be your stop out. But if you get some sideways consolidation Monday, Tuesday, Wednesday-ish, I think you can actually be a buyer on gold. And you should get some sort of pullback. I mean, the GLD has gone from about 114.5 all the way to about 119.5. That's a $5 move in 3 trading days off the lows. And, you probably do a retrace of 50%. That's what I would look for personally. You get a good retrace of 50% over the course of 3 days or so. It most likely is a good setup to go long short term on. And again, the beauty of that is you just keep your stop on a closing basis or a confirmation basis right below that low, and you stop out, and you're risking very little to possibly get another 5-10 points on the GLD to the upside. All right, next spot, by the way, of resistance would be right here. You have this little pivot top right here, and it's right around the 122, and the 50 MA is right there as well. So look for consolidation, look for a little bit of a pullback, and then I would start to get interested. Most likely for me, I would like to see, ideally, I'd really like to see this 116 20-ish area, this gap fill right down here. I don't know if it'll get there, so I'm not going to be a stickler. If it misses by 25 cents, I'm not going to not take the trade. I'll take it probably a little bit higher than that just to make sure I get in. But I am absolutely looking at the GLD now, folks. All right, SLV has also had a nice move here, another nice move. This one has gone up a little bit more. It wasn't selling off as much as gold, but for the most part, the upside is a little bit more limited on silver because of the 50 MA in the short term, a lot closer there. So I'd probably be playing gold on consolidation instead of silver. Oil continued its dramatic fall in the first couple days of the year. Right now, short term, a bounce can be looked at if you get down to the gap fill right here off this little tail. And again, that would be a nice 3-bar surge, 1, 2, 3, if we could get that on Monday. That would just be a quick swing trade long for a day or two, and you'd be looking at, just going into it, literally looking for 50 cents to $1 bounce. It wouldn't be a big bounce, but again, very easy money for a day or two holding to make some good green there. All right, any close, I would say below the 32.95 area, this low pivot here from this little tail, that would be your stop out right there. All right, on the downside. So limited risk, that's always what we want to look for, right? Limited risk and a good chunk of upside potential to it. All right, I would say $1 to the upside on the U.S. So if it bounces right there. All right, what are a couple stocks that I'm keeping an eye on here? Amazon still on my radar as a potential short at these levels, these lofty levels. What else do we have? Fedex. I'm keeping an eye on Fedex. Fedex, very weak after this wide range bar. This was a big sell candle. It was a failure of a bullish pattern, which is even more bearish. Any sort of bearish consolidation, this is going to go down lower, and I think it's just a matter of time before it dumps down to the 50 MA around the 137 level. That would be your next spot there, okay? So we will monitor that very, very closely as well. Any weakness in the market, that should go there. Following level would be the 136.50 level, and then you'll have a move down to about the 134 level on Fedex, all right? But again, that wide range bar on Fedex on heavy volume. Look at the volume here. So look at how Fedex was consolidating here. Look at the volume being 0, and then look at the heavy volume that surged. Major sellers up in this range of Fedex. Maybe Christmas is over, less package shipping, I don't know. But either way, bearish looking on Fedex for sure. What else do we want to look at? Everyone wants to talk about Apple. Apple actually is into some support here. I can extend this line right here, which I had before, and look at that. So 50 MA, and sure enough, Apple came into it. Most likely, you get a small bounce off of this level. If it gets below and closes below this, you could see further downside, believe it or not, all the way down here. All right, this would be your next major buy support level. Right now, I actually think there is some good support here, because notice how it hasn't hit the 50 in a long time. So there should be some support here along with this pivot low and this pivot high, but it's only a short-term support. And that's the one thing I want to make clear here is that Apple ultimately is going to go lower. Yeah, you'll get a little bit of a bounce, but I have turned bearish from being short-term bullish on Apple because of its price performance. All right, when it was breaking above here and it pulled back here, I thought maybe it could break up to about 600 when it never took out the high pivot. And this is important. This high, this is a lower high, and it started to pull back. That's very bearish. When you see a lower high, sorry, so we're going to take this high, higher high, higher high, and then on a pullback, it's unable to take out that high. That's where you go bearish when you start seeing that pullback. And sure enough, look at the fall it's had. So, sure, should it get a bounce off the 50 for a day or two? Probably. But is it going to go lower? Most likely, yeah. Yeah, be very careful with Apple, folks. Next stop, I would be an interested buyer at around the 510 level, 515 level. That would be my next buying opportunity as a swing trade long. Goldman Sachs remained strong on Friday, up about $1.25. This stock has had quite a run from these lows of the 200 moving average. If we zoom out on the charts, you're actually looking at, this is, you can erase this line, we don't need that line anymore, but this is your next major spot right up here. Right there at around the 186 and change level, and then if you get up to about the 193 level. So these are your next two shortable levels on a swing trade short on Goldman Sachs. And again, if you look at that, you should be in some good areas to rock and roll with that on the short side. All right, that's enough for today, folks. I don't want to overwhelm you. It's almost a 20-minute video here, but some good information, and hopefully you learned something. And I do encourage you to come join this 7-day free trial to the Research Center, which is geared towards investors and swing traders. And if you're a day trader, come join us in the intraday stock chat. I'm day trading all day long with our members next week, and should be a great time, as well as my partner will be there day trading alongside. So come join us here to themoneystocks.com and enjoy the wild ride in this market, which is going to be very profitable for us. Just a side note, last year net gains of over 400% in the Research Center. Hot charts and alerts, all right? So that's alerts given in the Research Center, over 400% gain. Even if you only took 10% of your portfolio and put them in each play, you would have still made 42% or so, which is insane. Think about the normal hedge fund. The average hedge fund last year made a couple percent, like 5, 6, 10%. Even the S&P only was up 30%. So we outperformed the S&P, which is, when it's up 30%, it's hard to do. Not many funds out there outperform the S&P, and sure enough, we did by a nice chunk of margin there. So, and to be honest, one last thing, the market, we make more money when the market's volatile, and it was not volatile last year. So if you think about that and think about the volatility coming here in 2014, should be amazing for us. I'm looking at 50+% gains or over 500% net gains in the Money Stocks Research Center this year. That's what my goal is, over 50% or again net gain of 500% if you put all your money in one play. But we never do that. We always do 10%. So look for 50% gains. I think that's a pretty darn good return. Not many people doing that type of stuff out there. Take care, guys. Come join us here at InTheMoneyStocks.com.